In January 2021, the global financial system was suddenly obsessed with a company almost everyone had already forgotten: GameStop. A struggling video game retailer, outdated stores, declining sales, shrinking relevance, suddenly became the most powerful stock on the planet. In just days, its share price surged thousands of percent. Hedge funds lost billions, trading platforms froze, and Wall Street found itself reacting instead of controlling the situation. At first it looked like a joke: memes, Reddit posts, internet chaos. But this wasn't random hype. What happened with GameStop exposed something far deeper: a structural flaw inside modern financial markets, one that had been quietly growing for years. A flaw created by leverage, incentives, and a system that assumed prices would always behave rationally. This wasn't just about retail investors beating hedge funds. It was about what happens when too much confidence meets too much borrowed money, and what happens when millions of people discover at the same time that a trade everyone believed was safe actually wasn't. To understand why GameStop happened and why it scared Wall Street so deeply, we need to look at the bet that was placed long before Reddit ever noticed. Part 1. The perfect short. From Wall Street's perspective, GameStop looked like a textbook failure. The company was built around physical video game sales, discs, consoles, and in-store purchases. But the entire gaming industry was moving in the opposite direction: digital downloads, online marketplaces, subscription models, and streaming. GameStop didn't adapt fast enough. Revenue declined year after year, and hundreds of stores closed. Analysts downgraded the stock repeatedly. By 2020, many investors weren't asking if GameStop would fail, but when. This made it an ideal target for hedge funds using a strategy called short selling. Short selling is essentially a bet against a company. A fund borrows a share worth $100, sells it immediately, and hopes to buy it back later at a lower price. If the share falls to $60, the fund buys it back, returns the share to the lender, and keeps the $40 difference as profit. If the company collapses, the payoff can be enormous. But there's a hidden risk. While a stock can only fall to zero, it can rise infinitely. That means short selling has limited upside and unlimited downside potential. Despite that risk, hedge funds became extremely aggressive with GameStop. They didn't just short the stock, they crowded the trade. Through a complex chain of stock lending, the same GameStop shares were borrowed and sold multiple times. One share could effectively be sold short again and again as it moved through the system. On paper, this is allowed. In reality, it creates a dangerous imbalance. By late 2020, more than 130% of all GameStop shares were sold short. More shares were owed than actually existed. At that point, the trade only worked if the stock kept falling. Any sustained rise in price would trigger a disaster. Most hedge funds believed that would never happen. They were wrong. Part 2. The short squeeze mechanism. The turning point didn't come from an earnings report or a company announcement. It came from the internet. On a chaotic subreddit called Wall Street Bets, users started analyzing GameStop's unusually high short interest. Some realized how extreme the positioning had become. This wasn't just pessimism, it was overexposure, and that's when a powerful idea emerged. If enough people bought and held GameStop shares, the supply available on the market would dry up, and if the price started rising, the short sellers wouldn't just lose money. They'd be forced to buy stocks back, which would drive the price even higher. This is known as a short squeeze. When a shorted stock rises, losses grow quickly, and brokers demand more collateral. If a fund can't meet those requirements, their positions get closed automatically. To close a short position, the fund must buy the stock back regardless of price. Now imagine thousands of short sellers being forced to buy at the same time. Each forced purchase pushes the price higher. Higher prices trigger more margin calls. More margin calls force even more buying. It becomes a self-reinforcing loop. Retail investors began buying GameStop en masse. Not because the business suddenly improved, but because the market structure itself was unstable. Options trading amplified the effect. Call options forced market makers to hedge by buying shares, which added even more upward pressure. The result was explosive. GameStop's stock surged from under $4 to nearly $500 in a matter of days. Losses at hedge funds mounted rapidly. One fund in particular stood out: Melvin Capital. Melvin reportedly lost more than half of its assets in days. To avoid the collapse, it received nearly $3 billion in emergency funding from other hedge funds. Wall Street wasn't watching from the sidelines anymore. It was in survival mode. Part 3. When the system showed its limits. As GameStop's price spiraled upward, the system began to strain. Then something unprecedented happened. Millions of retail investors opened their trading apps and suddenly couldn't buy the stock. Platforms like Robinhood restricted purchases of GameStop and several other heavily shorted stocks. Users could sell, but not buy. Officially, the explanation was liquidity and clearinghouse collateral requirements. Volatility had increased the amount of money brokers needed to post to settle trades. Technically, this explanation made sense. Psychologically, it was disastrous. To retail investors, it looked like the rules had changed mid-game. Buying pressure disappeared. Selling pressure remained. Prices fell and trust collapsed instantly. Congress held hearings. CEOs testified. The internal mechanics of modern markets, margin, settlement, leverage, were suddenly exposed to public scrutiny. And while the hype eventually faded, the consequences were permanent. Melvin Capital never recovered. In 2022, it shut down entirely. GameStop itself didn't become a tech giant. Many late investors lost money, but the event fundamentally changed how people think about markets. It showed that financial markets are not purely rational, that leverage can turn safe trades into existential risks, and that even the most powerful institutions rely on fragile assumptions. GameStop wasn't just a stock surge, it was a stress test, and the system barely passed. For a brief moment, Wall Street wasn't in control, and that moment will be remembered far longer than the price chart.